For those who have never heard about BlackRock, it is the world's largest asset management firm. I think it controls around $10 trillion and it invested into different stocks, bonds, even real estate. You can see the evolution of its stock price because you can actually purchase BlackRock stock versus the S&P 500 from the year 2000 all the way up to now. It has clearly outperformed and beaten the S&P 500 by a lot, and it has grown so much that it is nowadays so powerful that it even helps the Fed make decisions during tough times. For example, during the financial crisis and during the COVID pandemic, the Fed went to BlackRock to ask them for advice about what they believed the interest rate should be set at and if there should be quantitative easing to reactivate the economy. But how has such a big company managed to obtain such high growth rates for so long? Well, today we'll be looking at one of those men who has allowed for this to happen, who's none other than Rick Rieder, the Chief Investment Officer for Fixed Income at BlackRock. Rieder manages $2.7 trillion in fixed income assets. This is more than the GDP of some very big developed countries such as Spain or even Canada. He was the winner of the 2023 Morningstar Outstanding Portfolio Manager Award, which was primarily given for outstanding long-term returns and also for developing and sticking to a sound investment process. Throughout his professional career, Rieder developed his own personal investment process and strategy for fixed income, and this prize was primarily also given to him because the strategy worked really well because it beat the benchmark that is used to measure against a fixed income, but also he was able to stick to it. He was also able to adapt it to the changing market conditions, which is something that is very difficult for processes. He devours research and distills it into a diversified collection of small bets rather than a few larger ones. So he really enjoys diversification, especially when we're talking about bonds. We will also see his strategy for equity because he, apart from the $2.7 trillion fund in fixed income assets, he also has some insights about equities, which we will be speaking further into the video. He also says that he likes to monitor risks like a border collie, like the dog, but patrolling for strays and wolves. He's always on top of risk management, as he is known for his incredible appetite for data. He uses data for every single decision he takes in his management style. But we will move on to his philosophy because I think it is quite peculiar, and I think it's really good to analyze Rick Rieder because we normally analyze the great investors in equities. I do think that we can get a lot of value from looking at the master of fixed income assets because he has some advice and some philosophy that can also be applied to the equity market, and we can learn from a different perspective and maybe even take a lot of his knowledge into our strategy and use it to become better investors. The first one is his central pillar. He says that consistency for him is key. He believes that in fixed income assets, trying to make a little bit of money a lot of times, you know that bonds are lower yielding assets the majority of the year and the majority of the economic cycles. So this is why he likes to make a little bit of money a lot of times, and this also goes for his diversification. However, when Rick Rieder was asked about equities, he believes that concentration and scaling into your winners is what will give you the upper hand against the S&P 500. He believes that the most difficult aspect of investing is holding on to your positions. But he believes that this is the most difficult part when investing, and it is the part that generates the most amount of returns. So your job as an investor is analyzing and researching for the good stock, purchasing it at a reasonable price, then just waiting, which is when the returns are actually made, and deciding to sell out only when fundamentals change. His philosophy is based upon three key aspects, or the most important one for him is liquidity. So liquidity is key for a company because it always has to have either cash or short-term assets which it can dispose of whenever it needs to meet its short-term obligations, such as interest payments, even salary payments, or other needs that could arise in the short term. And then you get into the decision of cash flow and leverage, which kind of go hand in hand. Because leverage is really good for companies. It's a very useful tool as it can amplify your returns because you are borrowing money which you will be able to invest. And if the return you obtain from investing is higher than the interest rate you're paying, you're creating a lot of value for yourself. However, it introduces a lot of risk. And this should be something that you should take a look at. And how can you take a look at this? Well, by also looking at the cash flows. The free cash flow and the operating cash flow are key to decide whether a company can sustain its leverage or not. Because if the cash flow is greater than the interest payments, then it means that a company is safe and sound. In one of my previous videos where I talk about Terry Smith, he states that a company, in order to be in good financial shape, should have an EBITDA or a free cash flow that can cover more than 10 times their yearly interest payments. So if you focus on cash flow, liquidity, and leverage for any type of investment, you will already be one step ahead of the rest of investors who don't do this. His points to consider are 6 of them. I will go quickly through them. The first one is that you should conduct solid macro analysis. What does this mean? Well, you should focus on interest rates, different inflation, and central bank policies, where they're moving, how they are now, where you see them in the future, and base your decisions upon that. The second one is for you to be flexible. You should adjust your portfolios based on changing market conditions. For example, if you believe that the following few years we will be living in a high interest environment, maybe it's not such a good idea to get into real estate or into heavy machinery. But maybe it's a better idea to stick into banks. The third one is risk management. Diversification and a careful analysis of risk factors is crucial for Rick Rieder and should be crucial for you. Charlie Munger had one phrase which I really love. He said, rule number 1 in investing is never lose money. And he says that because he wants you to take advantage of the compounding effect. And if you lose money, the compounding effect loses a bit of its power. Fourth factor to consider is multi-assets. If you invest in different assets, it can help you optimize your returns and manage risks in different market conditions. For example, gold shines in a market where there is an economic recession or where there is high inflation. You can see our previous video on Ray Dalio where we explain his all-weather portfolio and how he diversifies into different asset categories. Number 5 is an active management of your portfolio. You should regularly review and analyze your investments, stay on top of the news, read their quarterly reports, and decide whether your company is still valuable to you, if they still have solid fundamentals, or if their fundamentals have changed and you should sell the company. And number 6, finally, you should have a global view, diversify your investments across regions. And I don't mean buy companies in India or buy companies in China as well. But for example, if you own a company like Google, inherently you are diversified because Google has a lot of the revenues that come from outside the US. So finally, if you manage to stay here, these are just some extra tips for that Rick Rieder proposed for the key to a great investing career. The first one is develop and stick to a plan. Sticking to a plan will make you be more structured and follow a certain rules whenever you're trying to invest in a company. And second, it also allows you to be more longer term oriented, which is great for investing since the majority of the returns are made in a long-term period. Second one is work harder than the rest. One phrase of his that I love is he says, I don't think I'm necessarily better than anyone else. I just prepare really hard. And this is the CIO of the largest asset management firm in the world. So imagine if we work hard, what we can accomplish. The third one is embrace tough times. Learning from mistakes is an essential part of the process, and nobody has gotten to the top or has become successful without making any mistakes. It's just part of getting better. So if you combine these 3 things, you will have a great investing career, you will become a great investor with a solid plan, and you will beat the market. So thank you for watching. As always, this has been the Cashflow Compounder. Join the free Patreon for extra content, and there is a link in bio for a free stock if you join Trade Republic or Trading 212.